really crazy things are happening in the JGB market. And, you talk about things breaking. I mean, things are breaking, if not are broken right now. And who knows what the near-term repercussions are. Every day is like walking on eggshells with the JGB market. And if you get a blow up in the JGB market, it's not some Silicon Valley bank, then that could be global cross-asset, repercussions spilling over. That's why I need to keep an eye on it.
Weston, welcome back to Forward Guidance. How you doing, man?
Hello, Jack. How are you? I'm fine, thank you.
I am great. I'm actually really happy, Weston, because I understand you've got some big news that you want to share.
Yes, indeed. It is a very happy, thrilling day for me today, Jack. I'm very thrilled to announce that I've joined Blockworks Macro. And I'm thrilled because of two reasons. One is that I'm reunited with you, Jack, my partner in crime. Always an honor to work with you. So I'm very excited about that. But the other reason is that I'm launching a brand new podcast on the Blockworks called Market Depth. And so those are two very exciting things.
That's phenomenal news, Weston. So glad to have you here at Blockworks Macro. And I love the title already, Market Depth. Why'd you choose that title, and what does it say about the type of content you'll be doing?
Sure. So market depth is, kind of a trading term or like a market sort of term where basically it refers to, in a nutshell, the more market depth there is for a particular security, bid-ask sort of, I guess, open interest in something, the more sort of activity there is, the more interest there is in that kind of that specific security, whatever it may be. But market depth also refers to the sort of two general categories of things that I'm going to be covering. So in kind of like a broad sort of overview, what this is like, people are going to say, do we need yet another financial markets podcast talking about the same repetitive sort of narratives? Of course we don't, right? What we need is an additional angle in approaching these markets. And so that's what Market Depth comes in, the podcast. Okay, so what I'm going to do is, from my standpoint here in Asia, based in Tokyo, I'm going to be bringing basically key market developments from the Asia Pacific region that you need to be aware of, cross asset class, right? Like equities, fixed income, FX, commodities, crypto. If it's a global market, global asset class with like Asia impact, you'll be hearing about it on Market Depth podcast. And since I'll be recording this at Asia markets close, those of you in Europe and in the US, you'll be able to tune in and just basically find out what's happened overnight for you guys, right? And so that you'll be better informed as you go about your day. So market depth, the two kind of subcategories of things or ways that I'll be, doing the show, is that it'll be kind of market price action from the day that happened in Asia, be it E-minis, whatever it is. And then the depth part is that I'll be doing also some deep dives as well. And not just like, here's today's sort of market price action. Here's what happened. Here's a cross-asset correlation. Here's the implications for, U.S. cash open, so on and so forth. Or the carryover from the U.S. Or weekend, news developments and market reactions and all that kind of thing, right? Because Asia starts the trading day. And so, I want to address that. But sometimes I'm going to do some deep dives, including my first episode, which is going to be launched on the 15th of May. So,
of March. Whoa, big.
I'm sorry,
15th of March, the
March.
next Wednesday. This will air. So we're filming this Friday, March 10th. It will air the same day. Your first Market Depth will air on March 15th, Wednesday. It would be bad news if people had to wait till May. They'd be, what are we doing? But yeah, no, they only have to wait 5 days. And yeah, so it's a timely show. It's about daily short-term price action. And that's important because people want to know what's going on. They don't want to be out of the loop. But then it's deep. It's a flaw of so much trading content is, oh, look at this line. Look at this line. The line's going up. The line's going down. Where you are the total opposite of that. You worked at some of the biggest, most respected banks in the world, trading equity, macro derivatives, stuff like that. So as if people don't know already, they'll see you're a very sharp guy. So you're deep, and you're also going to be doing those deep format, and you'll be specializing in the Asia region. You're at the Tokyo desk of Blockworks Macro, and Asia begins the day of trading because everyone, in Europe and everywhere is asleep. So the Bank of Japan news that for me was released at 3 p.m. my time. I'm here in New York, but that was much later in the day on Thursday on Friday. So that's what we're here to talk about, Weston, today. Today really is a new era for the Bank of Japan, because
Or
there's a
end
new
of an
guy in
old
town.
era.
It's the end. It's the end of an old era. Yeah, it's the final chapter. So, explain why it's the final chapter. Who is leaving, and why is that person Gus Fring, and why is the incoming person the sort of Jesse Plemons character? And because you made this really helpful graphic that will flash on screen. So yeah, what's going on here? Who's leaving? Who's departing? What's sort of the internal politics?
Sure. So today was a very, not just important day for Bank of Japan or Japan for that matter, but really global macro. Because, by the way, he's not leaving, but this is his last meeting as the sitting governor. But the Bank of Japan Governor Kuroda, after a decade, an unprecedented record long tenure, this is his last BOJ meeting before his tenure expires. And we have a new Bank of Japan governor coming in, which I'll get to in a moment. But this is a really big deal because BOJ Governor Kuroda has been around since 2013. So he overlapped with Ben Bernanke, just to put things in perspective. Okay, so he is the last of the QE sort of regime, and that he's been really doing QE on steroids still to this day, to the very end of his tenure. There's no sort of hiking cycle or anything like that. It's just been pedal to the metal QE, and to an extreme level up to his very last day.
Right, and just for the audience doesn't know, QE is quantitative easing. When the central bank adds assets to its balance sheet, it buys assets. Yeah. Go ahead, sorry.
Yeah, and it's not QE, it's QQE, so it's quantitative and qualitative easing. QQE basically means quantity is the amount they're doing. Qualitative is the types of assets that they're buying. BOJ is buying not just government bonds, but BOJ is also buying equity ETFs, so stepping directly into the equity markets, corporate bonds, REITs, so on and so forth. So when Governor Kuroda first came in, basically exactly 10 years ago, it was the March 2013 meeting. This was the start of Abenomics. Okay, this is arrow 1 of Abenomics that he kicked off. Large scale asset purchases, QQE, qualitative and quantitative easing. Qualitative refers to the amount, which eventually became 80 trillion yen of monetary base expansion. Quantitative is the amount. Qualitative is the type of assets that are to be purchased, and he expanded that to not just government bonds, not just JGBs, but to equity index ETFs. So the central bank is directly buying the equity markets, corporate bonds, REITs, so on and so forth. So that's what QQE is. So he basically did QQE in 2013. It was a massive bazooka. In 2014, then Prime Minister Abe increases consumption taxes on consumers, basically austerity in the middle of this very fragile recovery, and kind of just erased all the gains that the initial 2013 QQE sort of had started. Then in October of 2014, on Halloween, they do another massive shock QQE boost. This is Kuroda again. Then 2016, rates are cut negative in Japan, where they still remain, and Japan is the only country in the world with negative rates to this day, because the ECB and the Swiss National Bank are no longer in negative territory. And then in September of 2016, they introduced yield curve control, basically pinning the long end of the curve, the 10-year JGB yield, at around zero. And that policy still remains today throughout Fed rate hiking cycle, a rate cutting cycle, a rate kept at zero cycle, a rate hiking cycle again, and now potentially reaching a rate pausing cycle. And throughout all of that, BOJ's remain QQE, capping the 10-year JGB yield.
Right. So through all the slings and arrows of Powell's raising rates for the first time, Janet Yellen's raising rates, Powell's raising rates, there's a Powell pivot, there's a pandemic, rates are at zero, now we're way behind the curve, now we're going 25, 50, 75. Now we're at 475 all through. Europe has to do it. Europe's waking up. Oh my God, emerging markets, they're at 13%. Brazil's at 15%, whatever. Throughout all of that, the Bank of Japan has been
gone in ECB, negative rates gone in S&B.
Yeah, negative 0.1%, negative 10 basis points on the short-term rate, and the 10-year yield is capped at zero. A fun tidbit I learned from you. Again, we'll get into the details right now, but now we're just laying out the sort of the foundations for the audience. But fun detail I learned from you is that yield curve control originally was to prevent yields from going down further rather than going up, as many think.
The outgoing Governor Kuroda is Gus Fring, because there's a scene in Breaking Bad where Gus Fring is taking kind of live fire, like heading on, and he's walking into like this sniper who's just kind of, I don't know if you remember, bullets whizzing past him. That's basically Governor Kuroda, who's just standing firm in the face of like getting, live ammo shot at him, be it JGB shorts, JPY shorts, so on and so forth, all like criticism, so on, like he has just maintained, stood firm, unlike his other peers, for better or for worse. I'm not defending him, but I'm saying for better or for worse, there's no Kuroda pivot, right? This is how I'm doing things. This is how I run my business. This is how this is how it is. And just because he's gone, like Gus Fring, that does not mean that his policies are gone either. His policies, actually, the legacy of his policies live on. And that's the analogy that I give for Governor Kuroda, outgoing Governor Kuroda.
Right. That's perfect. Kuroda entered a dove, and he's leaving the Bank of Japan a dove, with interest rates still negative, 10-year yield still pinned between the range of at zero, even though the band has widened. So who's the new guy? Who's incoming Governor Ueda? And why is he the Jesse Plemons character? And what might be gleaned from that the Mike character, Amamiya, the deputy Bank of Japan governor, didn't step up to the job? Who is this Ueda guy? Had you heard of Ueda a year ago?
No. A year ago, a month ago, basically a month ago, nobody knew who this guy is, and this guy is now going to become the Bank of Japan governor. So the reason why he's Todd, okay, that might be a little harsh because Todd is quite a scumbag on the show. By the way, if you haven't seen Breaking Bad, stop like watching and learning about the Bank of Japan and all that, and watch Breaking Bad. That's like a priority. But Ueda, like Todd, is basically walking into a role, an extremely, complex and powerful and influential role that he really, with all due respect, has no place being, because of a lack of competency and a lack of ability to do it. And furthermore, he really has no time or chance to like learn on the job. And he just simply is a horrendous disaster of a Bank of Japan governor pick. Again, with all due respect. I mean, for that matter, so would I. So would most people. But the reason he was picked is not necessarily that he was picked. It's because there's nobody else who wants the job. That's like the main takeaway. And that's where Amamiya comes in.
So do you think Amamiya had the opportunity? He could have been it, but he said no?
Yeah, so outgoing deputy governor Amamiya, okay, he's Mike from Breaking Bad, the kind of old guy who's been around for a very long time. He's seen it all. He's been on the inside. He's been very loyal and all that, and now he's too old for this shit, basically, is what I say, right? When Ueda was chosen, everybody scrambled around to find out like who the hell is this guy and all that, and they're they're looking at like past research papers and all that. He used to be on the Bank of Japan governor board of governors like in like the late 90s till early 2000s, and so that's frankly it's an irrelevant time like era to draw from experiences from. And since then, he's actually currently been a university professor until about a month ago when he was suddenly tapped to become the Bank of Japan governor. A nobody, right?
And has he made any statements about, I love negative rates are way too low, QE is not enough, the balance sheet is too ridiculous? Has he made any statements at all, or what do we know about what he believes?
So he just is currently parroting the Kuroda sort of line, as he should be right now, in this transition era. Even if he doesn't
right. And just to be clear, when he was an academic, was there any time where he wrote anything saying rates are too low? Or because to an outsider's guess, this is me, an outsider guessing, it could be that Bank of Japan policy is way too low and you want to reform the institution. So if you want to reform the institution, you don't just get the number one's right-hand man. You don't make the number two guy the number one guy. You get an outsider, someone who can improve the system, who's not an insider because they haven't been corrupted, to use a judgmental term, but they like Jay Powell is kind of an outsider. Maybe the interest rates would have stayed lower if it was another sort of dovish person in 2017 who replaced Yellen. Powell was like an outside guy. He was a banker, he was a lawyer, he had served at the Fed, but he was not an academic. Ueda also seems like kind of an outside guy. So do you think that Ueda has maybe like a higher chance of being able to raise rates and get off of negative 10 basis points than Amamiya, or what? What gives you confidence that he will stay on this negative 10 basis points track?
I don't know that he'll do that. I don't know what he'll do at all. Nobody does. People are, making guesses as to what he's going to do. Like, frankly, he doesn't know what he's going to do either, right? So let me just just answer your question. Regarding Ueda, basically his beliefs and all that, we simply don't know what they are. We don't. Like, I've watched all the parliamentary hearings and all that, and he's doing what he's supposed to do, which is just to maintain and keep like repeating the Kuroda playbook as he should be. Like I said, because you can't like just if he starts talking about something else, he's gonna just create this unnecessary volatility to walk into. Which is a reason why I thought that today there's also going to be no surprise, change in policy for the Kuroda's last BOJ meeting, because why would he hand that off to this incoming person, right? So let them do that and deal with the volatility. It's not you're not helping anyone by doing a last minute policy change. But with regards to Ueda, we just simply don't know. But it doesn't really matter in my view. Who it is. It doesn't matter if it's Ueda. It doesn't matter if Kuroda has a third term. It doesn't matter if it's Ben Bernanke who got chosen for the Bank of Japan governor. Because in the grand scheme of things, in the big picture, yes, they might be able to try to shift policy. They might try to abolish yield curve control or increase the bands on it or get rid of the negative interest rate or whatever it may be. That part actually they might be able to do and just kind of leave it. But in terms of yield curve control, in the grand scheme of things, they're going to have to come back to it at some point, right? They're not able to abandon these policies. The policies that I mentioned before that that Governor Kuroda has done over this past decade, this completely, unprecedented level of easing, policy experimentation is what it is. Like, this is what Bank of Japan does, right? It leads the other central banks with policy experimentation. But when you're owning half the JGB market outstanding, when you're setting prices on the other half, when you're basically you're micromanaging each sort of JGB issuance, like the 10-year issuance issue by issue, what you can lend, what you can what they're targeting to buy unlimited amounts of, how much they own over 100%, so on and so forth. And when it's getting to that level, it's like really messing up the like financial functioning of the market and the dysfunctioning. At some point, you're going to have to come back to capping yields or to accommodation, just like the Bank of England had to do temporarily in what was it, September or October of 2022. So my broader thesis is that the Bank of Japan is no longer run by the personnel; it's run by the policy. The policy runs the personnel, not the other way around. It doesn't matter who it is, who's in the seat. They basically created a Frankenstein. They're kind of stuck in this this world now, and they have to now just continue to deal with it. They can attempt to make tweaks, but they're going to find themselves having to resume maybe in a different name or whatever they want to call it, but some sort of accommodation.
People made a lot of arguments about the United States a year ago because the U.S. debt was so large. U.S. debt as a percentage of GDP is large, not nearly as large as Japan's, but it is large. And for that reason, people said Powell can never hike rates. He may get to 50 basis points or 1%, but once he does that, he's toast. And now interest rates are at 4.75%. And I'm in New York. Things are fine. We're still breathing oxygen over here. The sun still shines. So yes, it's a long-term thesis. Okay, debt sustainability costs, but that really, if Ueda wanted to hike interest rates in Japan to 3%, I mean, he could, right? There's nothing impossible in monetary policy, and the Bank of Japan has showed us that.
Yeah, they can they can attempt to do whatever they want to. Of course, they could. The Bank of Japan, just like you said, is the pioneering central bank. So, if they want to try to So they're the biggest in the whole, right? They've done the most amount of easing. They have their assets on the balance sheet are 120% of debt to GDP, which is twice the runner up, which is the ECB at 60%. And well, the last time you and I spoke, we were talking about how much QE they were doing going into the January BOJ meeting. Just in those like 2 days alone, or over the course of January, they were doing 50% more QE notional amount, $180 billion worth of QE in January alone, which is 50% more than peak Fed QE. On a notional for notional basis. So yeah, they could do that, and then if they want to try to unwind the greatest QE and like balance sheet like unwind of all time, of course they're free to do whatever they want to, but they are going to be constrained by the same exact reasons that Governor Kuroda could not remove yield curve control throughout all of 2022, even at the expense of a yen getting killed 33% at its lows year to date. This is a policy that you cannot have borrowing costs in Japan increase. You already have basically 1/4 of Japan's budget going to just servicing debt, existing debt, right? For their 1 quadrillion yen of outstanding bonds. That's with a low that issuance is done on a very low rate. If you just have that 25 basis point sort of 10-year yield cap that most of yield curve control was at, if you basically have that at like 1% or 2%, so if basically borrowing costs quadruple or quintuple or what have you, you're looking at like the entire budget used simply to service the debt existing.
So, right. Okay. Yeah. Those numbers that you laid out, 1/4 of Japanese government expenditure just goes to service the debt, and interest rates are at 0. So that does paint.
Well, they're not at 0, but they're
more
or less.
The 10 years that
they're not at 400 basis points.
Yeah, the 10 years at 50 basis points. It's pinned at 0 with a range of -50 or +50 basis points.
Spending goes up, and spending's going up. The demographics are against them. You don't have there's more people that are becoming tax dependent rather than providing the tax revenues. They have to keep issuing JGBs.
Wes, I've got a question about demographics. So aging is Japan's demographics. It's a very aged population. It has been aging rapidly for 40 years, and to some degree that it explains the economic phenomena, monetary phenomena. But is it still getting worse? Is it still aging?
Sure. Yeah. If you look at the demographic pyramid, but yeah, like demographics is the one thing I forgot who I heard this from, but it's the one thing that it's predictable. You can see it. You can see like what the consequences of China one-child policy was, and so on and so forth. Like you can see decades into the future of what your population makeup is going to be. Now, how you're going to mitigate that with immigration policy, all that kind of thing. That can be the dynamic that changes. But as it stands right now, Japanese people are going to become extinct in like 300 years, essentially. So either way, like the debt burden is just getting massive. It already is. It's getting even more massive, but they can continue to do this so long as they cap yields on JGBs and they continue to buy JGBs at extremely large, notional amounts.
What happens if inflation has gone from 0% to 4%? What happens if inflation goes to 5% and stays there, or 6% and stays there?
Japanese people are gonna have to pay more for things, like. Like the thing, so like Japan, everyone from a Western mind frame looks at like Japan inflation, all that, and yes, it's an issue, but it's almost insane when you hear them talk, like not just the Bank of Japan and Governor Kuroda, but like incoming Governor Ueda, when he was before Parliament just 2-3 weeks ago, and they were talking, and they were like kind of grilling him. Some of them were grilling him, some of them were not. But when they're talking about Japan inflation and CPI and stuff like that, they're talking as if present day inflation is not only not above 2%, but they're talking as if it has yet to hit 2%, the 2% target. They're saying like, so what if Japan actually reaches above the 2% target? Japan core CPI is at 4.3% right now. Like that, it's almost like they're almost living in a different reality. Now, what they're talking about
is wild
is
because Japan is like the deflation capital of the world over the past 3 decades. Yeah. So
And so the projections of the assumptions by the government, by the BOJ themselves, are that this is temporary. This is not Japan inflation. This is obviously global inflation. And
temporary.
so
Where have I heard that? What's the synonym for temporary, Weston?
the Japanese word for it is transitory. So
Yes, exactly.
yeah. So but it, to a degree, I do kind of agree that look, if no other countries were experiencing inflation right now except for Japan, then yeah, that would be Japan inflation. But if you're looking at every other developed nation, that was almost, even the U.S. was almost flirting with like a 10 handle on CPI, and Japan is kind of creeping up into the 4 handle. That's clearly a global sort of phenomenon, and Japan still lags by almost half in terms of inflation. So inflation isn't a concern necessarily enough to dial back the easing policy that they've implemented. It's not. It's That's what Kuroda's last press conference and every press conference before that has been all about.
Right.
That it is not early, and it's not enough time and all that kind of thing. And then the one other thing is that they're looking for wage inflation. They want to see wages grow in Japan. Wages are going to pick up in Japan. You see like headlines of like fast retailing, Uniqlo, like increasing 40% wages, stuff like that. Not just that,
Really?
but like kind of, yeah,
40%?
40%, right? But if they're going to do that and it's going to be like a headline article, it probably means it's a kind of outlier anomaly. Nonetheless, you are going to get wages to increase. You are not going to get real wages to increase at all. And when people get their wages increased this year, the mindset is going to be that this is kind of a one-off thing. And when Japanese people receive a one-off payment, like in COVID, that goes into the mattress or into like the zero yielding bank account. It sits in cash. It's almost deflationary when you increase like somebody's sort of income. So if it needs to really be like sustained year after year after year, and this is why it needs to. This is why they're saying it needs to take time for them to assess whether or not this is real, sustained. Is it cost push inflation or not? And until we get proof of that, we must maintain our policy. And I sort of agree in that sense that if you've done this for this long, you've gone this far on the hole, you're not just going to pivot on a few prints of 4% core CPI, and yet to see any sort of evidence on any real wage inflation taking place. So for now, they're going to continue to do this. This is another reason why I don't believe in this thesis of just ripping off a band-aid of yield curve control and all that coming with a new guy or otherwise.
Right, Weston, let's talk about the price action. So today, there's no action announced at the Bank of Japan news, so interest rates did not go higher. As a result, you have some bank stocks in Japan crashing. Sumitomo going down, Mitsubishi, many other banks going down. To what degree do you think that it can be explained by the fact that, interest rates didn't go up and rising rates are good for banks, or so they tell us? Or do you think it's part of the sort of global worry about bank stocks? In the U.S., bank stocks were down like 4% yesterday, and Silicon Valley Bank, SIVB is the ticker, down 60% yesterday, down 40% in after-hours trading. It was halted. Really wild stuff going on there. But yeah, so how do you sort of explain this really bearish price action in the Japanese banks?
The Topics Banks Index versus Topics. You'll see that. So the overnight, hit to global banks actually did push the Topics Banks Index down. They were down about maybe 2% or so before the BOJ policy meeting came out. So like in the AM session. But when the BOJ policy meeting came out and there was no change, right? No change basically means no more increasing of the tenure JGB yield band, and therefore no more sort of net interest margin potential to widen, and therefore a crash. And basically, you saw the bank stocks take an enormous hit. Like you said, like these, if you look at the turnover for the day, all these names sort of listed, you'll see that these were the most active names were the bank stocks, the single stocks. And then within them, you'll see like the regional banks, Resona Holdings, for example, and so on and so forth. They'll take you down 7-8%, even more actually. But they're all getting hit. But they got hit after the BOJ meeting. So that could be interpreted in many different ways. It could just be like, let's wait to see what the BOJ is going to do before they were going to sell anyway because of what's happening with Silicon Valley Bank. Or this was all that Silicon Valley Bank price action was in the AM session, and then this was a reaction to the BOJ, standing pat. But either way, the Japanese bank stocks have been the most kind of like breakout to the upside since December of all the bank stocks globally. And this includes the Euro stocks banks, the KBW, whatever it may be. And so if you're going to start seeing profit taking, it's going to happen in Japan. And the bank stocks like MUFG and all that are probably going to get, beaten down very, very heavily, I would think.
Right. And those Japanese banks rallied in part because, the Bank of Japan is widening their yield curve control band. So interest rates are rising, and that means banks can get a higher yield on their loans. And yes, that is true. However, in some cases, it means that banks have to pay more for deposits. It's not just about the assets, it's also about the liabilities. And in the case of Silicon Valley Bank, the venture capital has kind of frozen. Private equity, no deals are being done. So companies that had deposits there are pulling their money. So there's a kind of a bank run at Silicon Valley Bank. That being said, do I think JP Morgan's going to be fine? Yes. But Weston, what do you think?
It's kind of a consequence of a rising rate environment, right? That they essentially this is what kind of exposed that, I suppose, or maybe created this, and they're having to shed these assets. And if you're not holding a bond to maturity, you're taking massive mark-to-market losses, right? And this is a scenario that this is kind of how I was thinking about, like, if the Bank of Japan starts to lift yields, like on the long end, essentially yield curve control, like getting more and more like phased out, you're looking at massive like mark-to-market losses on JGBs that were supposed to have like an explicit floor on them. And that creates a massive problem for holders of those JGBs as well, including banks, insurance companies, pension funds, so on and so forth. So I think that there are like parallels to that, not to mention the parallels of the actual market volatility and the more sort of technical volatility explosion that could happen in the rates market that could spill over to the treasury market and so on and so forth.
Right. So if rates rise, banks can make new loans at higher profitability. However, the loans, or more accurately, the often securities like government bonds or mortgage-backed securities, they go down in value as interest rates go up. So it's kind of been, it's like, which is the increased profitability on loans, is that better, a more positive force than the negative force of the mark-to-market losses on these securities? And by the way, many banks don't have to realize those mark-to-market losses because they hold them in their HTM portfolio, hold to maturity, as opposed to AFS available for sale. Yeah. So what do you think? Would rising rates actually be good for Japanese banks? The market seems to think so.
I think that at this point, like the expectations of the positive earnings impact that Japanese banks, like let's tell the three mega banks being MUFG, SMFG, and Mizuho Bank, which are, by the way, they all three of them have US ADR tickers as those tickers. MFG is Mizuho, but the upside from like potential net interest margin positive earnings impact seems pretty well priced in. That's not to say that they can't have a runaway momentum like upside, which has been going on, but as I mentioned to you the last time I spoke to you, I rode that kind of, the MUFG long from December meeting to January. I closed that out, bought puts. They were basically worthless thereafter. But I think that, I don't really think that there's like too much like near term upside from that, because of the policy itself. I don't think that there's going to be a massive spike in JGB yields. That said, though, there is something that kind of is a very out there and like kind of interesting thought that I was thinking just the other day. But from a longer term perspective, it actually might be interesting to go long these like very obscure, smaller regional Japanese bank stocks that are left for dead for good reason, that have been left for dead for a long time. And that's the reason why is because so there are more than 50% of household assets are in cash, and so therefore they're sitting in these banks. A lot of people, like we're just talking about demographics in Japan, are dying, and they don't have like families or anything, and so they're dying and they're leaving enormous amounts of cash just like kind of scattered all over these banks, these like regional banks, and they just sit there and there's nobody to claim them. There's nobody to even tell the banks that this person has passed away or whatever it is, right? And so I have to look into this deeper, but there's something where in which like if you don't touch your like account for a long time, they can start to like charge, you know, they're already not paying you any interest on it, but they can start to like charge you for, you know, X amount of yen. It's like 1,000 yen, $10 or whatever per month or something. But at some point they can kind of claim those assets, if I'm not mistaken. And I have to look, don't quote me on that. I have to like really look into it. But there might be it might be an interesting play to go long these, because there might be a time where a lot of Japanese people pass away. They don't touch any of this, the over 50% of their, you know, cash that's being held in cash in these banks, and then that just suddenly becomes like a, I don't know, like an income like stream for some of these smaller banks, and the more that people kind of, you know,
do you have a name of an example of a type of bank?
Of what? So look, again, this is something that just occurred to me recently, so I have to like really look into it. But if you look at the list of all those banks that, you know, of the performance of the day, like with the exception of the three big ones and maybe like Resona on top, like look at any of those, and those are all kind of very obscure smaller banks.
So I want to look at the yield curve of Japan later, get into the dynamics, but just looking beyond Japan, let's just take US, for example, you know, maybe Europe. How are you thinking about the markets there in terms of rates, stocks? Are you seeing any opportunities? What stands out to you?
Since October of 2022, the Bank of Japan and the PBOC, the Chinese Central Bank, have combined added a net like 1 trillion of liquidity to the market. So if you're just looking at the Fed or the ECB, it might seem like, oh, this is like a tightening environment and all that kind of thing. But it's being completely offset by, not completely, but it's being in large part offset by what's happening in Asia. It's going to, you know, Asia's two biggest economies and central banks, the BOJ and the PBOC, have been massively easing. And that's been offsetting this tightening and this QE that's been going on in your neck of the woods and in Europe, and that's also providing upside to equities, as we have experienced year to date. So I am of the belief of that as well. This is why I've starting this, you know, podcast with Blockworks, to cover from the Asia perspective so that everyone sees the full global picture. And if the BOJ is indeed going to stop like providing liquidity, if the PBOC is also going to, or not, like I think that those are going to be the make or break sort of liquidity providers from a central bank, from a monetary policy perspective, into things like equities and all that. So it depends on you know, what they're going to do. Now I happen to think that the BOJ is going to continue to ease as well as the PBOC, and so if indeed those are helping risk assets drive higher, I see upside in, you know, over the next say 2 quarters or so, or, you know, this year in the equity market.
Got it. Weston, now let's look at this chart of the Japanese government bond yield curve. So what are we seeing on the x-axis, the y-axis? What are the dates, and what can we infer from this? And why is there such a big chunk, such a big hump in the middle?
This is the reason that the Bank of Japan lifted yield curve control bands back in December. It's nothing to do with CPI or anything like that. This is why. This is the JGB yield curve is a very messed up looking yield curve, because you see that like kink right at that 10-year mark. That 10-year level, that's where there's so much concentrated buying, because the 10-year JGB has now become a policy rate in addition to the negative 0.1% overnight rate. So now that they made it a policy rate and they're concentrating so much buying, they've made this kink such that 8-year JGBs, 9-year JGBs are not only yielding above the 10-year JGB, but they're yielding above the, you know, yield curve control so-called cap, right? So that's what they tried to smooth out. That really backfired in December. January they stepped pat, and then they stood pat today as well, and they're going to, because they learned that is not improving. That kink is not improving. As you can see, like the red line is most recent. The blue and the red line is basically from January to monetary policy meeting to today's monetary policy meeting, and that kink still remains, right? So lifting the 10-year yield curve control band isn't doing anything in smoothing this yield curve out. If anything, it's making them have to buy even more, because the markets are now thinking that yield curve control is going to be gone, and they start shorting the hell out of 10-year JGBs, and they have to keep buying more, and then they do more QE than the Fed does in 1 month, and so you get this same sort of problem. That's what the lesson that they learned, and I think that that's something that they've really internalized over the month from December to January. They learned, like, we can't touch yield curve control bands, because this is the kind of the insanity that happens. So this yield curve is gonna probably stay, and there's really nothing that they can do about it. If you go to that next screenshot though of the market conditions, yeah, okay. So what this is the actual reason that they cite, and what I believe is the reason that they also made a move on yield curve control. Bond market functioning, right, or dysfunctioning. So you'll see on the right side, from the on the bottom side, you'll see that, like, that was from November, a survey of bond market participants, taken. So there's a survey taken of bond market participants, like JGB, actual buyers and sellers of JGBs, like 80 institutions, and market makers and dealers and so on and so forth, and like bid-ask spreads and so on and so forth. And so it's like basically how are market conditions? Are they getting better or are they getting worse? And if they're getting more worse than they're getting better, that line goes down. And so you can see basically in November, early November, when that survey was taken, bond market conditions were like dropping to the lowest levels sharply. That's what changed, and that's what made BOJ adjust yield curve control in December. After that, however, the most recent period was this past February 1st to February 7th. Bond market conditions have worsened even more so. Like their mitigation measures of like expanding yield curve control and all that just made things once again worse. And so therefore they realized that like the prescription is actually killing the patient even more so, and that's why they're not going to, in my view, be so quick to move on removing the cap on JGB yield curve control, and or for this reason and or for CPI reasons. I think that's here to stay.
Thanks, Weston. Been great getting you back on Forward Guidance. People should follow you on Twitter at Across the Spread, and they should follow your new show, Market Depth, which comes out, the first episode, on Wednesday, March 15th, and there will be a link in the description of this episode. Weston, just what are your final thoughts on the Bank of Japan, and how are you seeing this playing out? What do you see the odds of, in a year, the policy is the exact same of negative 10 basis points and yield curve control of 0 on the 10-year yield. And if it is the case, I mean, is the Japanese yen a lot weaker because Japanese yield is yielding 0, and Europe, US are all yielding 3, 4, 5, maybe 6%?
So I think that, first of all, thanks for having me on your show. I would I invite you to join me on on mine as well, on Market Depth, if you want to, but that's going to require you to wake up at Asia market close, which is about 3 a.m. your time. But what I'll say is, look, looking forward, I don't know. The reason I don't know in terms of dollar yen levels and all that is because I do believe that yield curve control remains, some form of yield curve control remains, and some form of like permanent accommodation in Japan remains. And so it's things like dollar yen and all that is going to be a U.S. Treasury yield level call. And I don't really have a particularly strong view either way on that. But if U.S. Treasuries fall, essentially, and JGBs remain capped, or if U.S. Treasuries rise and JGBs remain capped, you're going to see that yield spread widen. You're going to see dollar yen, therefore, continue to increase, and therefore, yen's going to continue to get just sort of blasted downwards. What I'll say though is that regarding the incoming governor, right? For the next month, you're going to see probably extreme volatility because right now we're in between two governors. We're in between Kuroda and Ueda. Kuroda is like a staple. He's Gus Fring. He's known as like he is the institution. He's basically like when Gus Fring suddenly gets his face blown off, right? The like the lab still remains. The operations still are out there. They don't just disappear with his half of his face, right? So what's gonna happen is that this Ueda guy's gonna inherit this like Kuroda, the Kurodanomics dynamic, and that's a dynamic that is basically battling markets every single day on a daily basis. It's a fist fight against JGB shorts, and if not that, against JPY shorts and political pressure and so on and so forth, right? So Governor Kuroda has been able to do that more or less because he's been able to literally laugh it off. If you watch any of my kind of meme things that I like make, or any sort of English speaking interview, Governor Kuroda is constantly laughing. Like it's almost like involuntarily so, like he can't control it. That I believe has literally saved Japan many times because it shows like confidence, like in like I will not move on my policy. Period. I don't care what the Fed and the ECB are doing. I don't care what CPI is doing. Yields are capped. Period. Easing must be maintained, and so on and so forth. If you now look at this guy who just got picked out of nowhere because Amamiya ran from the job because he saw what's happening on the inside of BOJ and nobody wants a job, and this guy was picked last minute and thrown into this role, and he's having trouble kind of getting like words out and sounding very nervous. In other words, being the exact opposite of presentation-wise of Kuroda. I don't see how like the shorts are not going to try to just blast this guy and the JGB market. So I think that you're going to get a ton of market pressure of like the BOJ is going to break. We're going to make the BOJ break, and I think that they might find some success, but ultimately they won't because again the institution and the policy runs the show and not the individuals within, and they're going to have to come back with some sort of drastic easing policy to combat the shortly to combat the what is it like the victorious for a temporarily victorious short sellers and non-widows of JGBs. So I would think that if you see a move like that where yield curve control is like gone and all that, and markets are pricing for that, that's an opportunity to look at time it well, but that's an opportunity to potentially look at reintroduction of easing coming back.
Interesting. But you said the shorts will get an opportunity. Obviously, so many people short the yen, short Japanese government bond market. But in the same way, when a stock declines, the CEO says the short sellers are attacking. But often it's just people who are long the stock selling some of their holdings. Like it also could be Japanese institutions saying, "Hey, we don't want 0, we want 5% in U.S. Treasuries." Oh, and by the way, the whole argument of the Japanese yield should be lower because Japan doesn't have inflation. That argument is now thrown out the window, right?
Right. And to that point, I just want to mention, by the way, that, again, this is about market dysfunction. JGB, 10-year JGBs, issue by issue, so like issue number 368, number 369, number 370, these are different issuances. They are trading, and their yields are so dispersed from one another, such that 10-year JGB issue number 368, okay, today, actually hit a negative yield. So that issue is actually, that 10-year JGB yield is actually yielding, I think it's like in like some low teen basis points and not at like the 50 yield curve control cap, but it actually hit negative today. It's not the one that that you see quoted on screens everywhere, but you are getting some insanity in like the JGB markets issue by issue, and that's why they're managing this issue by issue. That's why this sleepy professor who's going to become the Bank of Japan governor, again, with all due respect, he doesn't know what he's walking into. Whoever accepted the job, if you're qualified to accept the job, you wouldn't take the job. The only people who would take the job are those who don't know what they're walking into and therefore are not qualified for that job. I don't care who it is, but this is who it is. And so the really crazy things are happening in the JGB market, And you know, you talk about things breaking. I mean, things are breaking, if not are broken right now, and who knows what the near-term repercussions are. Every day is like walking on eggshells with the JGB market, and if you get a blow up in the JGB market, it's not some Silicon Valley bank, then that could be global cross-asset, you know, repercussions spilling over. That's why I need to keep an eye on it. That's why you should watch my show starting on Wednesday, the 15th.
Which is called what? Which is called what?
Market Depth. And
Market Depth.
And make sure that you subscribe, because these are going to be very time sensitive to that day, right? So you don't want to miss any of that.
Definitely. So it will be on YouTube on Blockworks Macro, the same channel where Forward Guidance. This show is airs on YouTube, but on podcasts, so Apple Podcasts, Spotify, and all the other ones, it will be Market Depth, and so you got to subscribe to that specific one. Weston, we'll leave it there. Thank you so much, and thank you everyone for watching. Looking forward to your first episode.
Thanks so much.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro, or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.